Make sure you are sitting down for this one, ideally with a stress ball in one hand and a stiff drink in the other. We are tackling impairment. If depreciation is the slow death, impairment is the sudden heart attack. It is the moment the accounting gods look at your assets and say, "We don't care what your spreadsheet says. This thing is trash." We already depreciate the asset. Every single year, we dutifully lower its value. We are following the rules. But that is not enough for the sadists at the IASB. They want us to constantly check if our assets have suffered a sudden loss of value. It feels personal. It feels like the auditors are walking around the factory floor, kicking the machines and asking, "Are you sure this is worth $5 million? Because it looks like a pile of rust to me." It is the ultimate mood killer. You're having a bad year, sales are down, morale is low, and then the accountants arrive to say, "Hey, let's write off another $20 million from the factory value because the market has crashed." It turns a bad year into a catastrophic one. Remember the pandemic? You bought a $2,500 high-tech exercise bike. You were going to get fit. You capitalized that bike on your personal balance sheet at $2,500. 2 years later, the bike is currently serving as a very expensive drying rack for your towels. You check eBay. People are selling them for $500. You calculate how much health benefit you will get from it in the future. Result? 0, because you are lazy. The impairment test. Your books say the bike is worth $2,500 and maybe minus a little depreciation, but the reality is that it is worth $500. You are currently walking around telling people, "I have $2,500 worth of gym equipment." That is a lie. You have a $500 towels rack. Impairment is the moment your spouse forces you to admit that you wasted the money and you need to write the value down to reality. Under the rules, you must test for impairment if there is an indication that the asset is damaged, obsolete, or the market has crashed. The test is brutal, but logical. You compare the carrying amount to the recoverable amount and take whichever is higher. If you can sell the machine for $1 million, but you can make $2 million by using it to build widgets, the asset is worth $2 million to you. You do not impair it down to the sale price because you are not stupid enough to sell it. However, if both numbers are lower than your book value, you are in trouble. You must write the asset down to the higher of the two. Here is the dark secret of the CFO office. Impairment is a strategic weapon. When a new CEO takes over, what is the first thing they do? They impair everything. They write down the value of factories, goodwill, inventory, everything. Why? They can blame the old CEO, and by smashing the asset value down to 0 or low today, they drastically reduce future depreciation expenses. Lower depreciation in the future means higher profits in the future. So, the new CEO looks like a genius 2 years later when profits soar, simply because they flushed all the expenses down the toilet in year 1. If your asset's carrying amount is higher than what you can sell it for or use it for, you are lying to the shareholders. Impair it. Take the pain now. Just try to time it so you can blame it on market conditions rather than your own bad purchasing decisions.